am Charles Abugre. I am currently associated with a little research group in Ghana called TAMA Foundation, but I'm also transitioning in October to be the full-time executive director for the International Development Economics Associates. And so maybe at another time I might have a slightly different identity, so I might as well just say that. Thanks, Jason, for not having a heart attack, waiting for my presentation to arrive. In northern Ghana, we have a serious flooding problem, so we get caught up by mundane issues. So apologies for that. Okay, so I think I was asked to, do some reflections around the political economy issues that drives Africa's debt. And I think my guidance notes expected me to sort of take a little bit look more at the political relationships with our main creditors, but also a little bit, and especially, in view of the changing nature of the structure of Africa's external debt. And then maybe talk a little bit about the implications of these political relationships for the way the debt might or might not be structured and its implications for economic and social development. I'm afraid I departed from that a little bit, not in the main paper, but in the presentation I want to make. I thought that I should sort of, be a little bit, go back a little bit to the foundations and embed Africa's current debt and its continuous, up and down debt overhang on the fundamentals of the global economy in which Africa finds itself, especially as the weakest continent in terms of the economy. In terms of political space for negotiating anything, that where we are as a continent is not simply the makings of the internal politics. So I thought I should go back a little bit and explain why fundamentally we couldn't expect much better than the situation we have faced on and off since many countries on the continent gained independence. So let me see where I move these things for. Sorry. Can you see? So I think we should take a more careful look at the foundations of debt in which we are at the weakest end of it, and the foundations lie in the way in which the money has become debt, and debt has become the main creator of money supply. So that conversion of money historically into a commodity rather than what it originally was, the creation of human societies for exchange of services, goods, for a common good. And that social form has been commodified. And this commodification has created two distinct characteristics. One being, first, that money itself is debt. Money has become debt. So whether this is issued by states or they are owed by households and firms to private creditors, unless repayment happens, debt cannot be extinguished. Now, increasingly, how did that happen? Now, states also issue notes, but these notes ought to represent a balance sheet of social accountability. But the notes that states issue and the paper that it prints also becomes a private obligation, a private contract. So money has changed in form from being something that is an idea that serves society into a commodity. Now, the first earliest form of commodifying money was the finding a metal and creating a coin. Now, that metal carries the concept of value that can be stored and changed. Now, initially, it then evolved into a form where the metal itself, gold, is weighted in value, similar to the actual good or service it exchanges. And therefore, the system of money then eventually evolved around the concept of money as a commodity. Now, of course, this didn't survive for too long, as we see from the fall of the Bretton Woods system, where gold eventually became the dominant source of exchange, and so value and trade is directly, or money is directly converted with the gold. So that eventually gold itself, as value started to decline, there was simply not sufficient of it to make direct exchange, and it collapsed. But it also collapsed for political reasons. It collapsed because the United States needed to be freed up to print paper money, which is the next phase that we are talking about. So by basically, converting it into a commodity and printing paper money, the central governments were unleashed. Interestingly, governments, especially the government of the United States post-World War I, constrained themselves from printing that public paper and conceded the creation of public paper to private banks and private finance institutions. Okay, so that's the first thing to remember, that the suddenly money, which is a concept, a social concept for exchanging and sharing value in society, became commodified and making it easier to make it privatized rather than social, with the state playing a role in facilitating the privatization, not necessarily through a direct commodity exchange, although the commodification has also evolved in some forms, but in basically protecting the space for private issuers of paper. That event that basically becomes debt. So you have it, it is basically because you derived it, it's been lent to you, you get it through a creditor system, and so on. So that's the first thing to remember. The second thing to remember is the way that it's been managed, how capitalism has transformed the way that is being managed. So, as I said earlier, it shifted it from being a social purpose, where both parties are held to account, have this similar obligations for the purpose of creating social stability. So contracts between two parties, both have equal responsibility. You lend the money to, badly, the other cannot pay. Both of you have a responsibility to resolve this in order to create stability in the world. unfortunately, capitalism transformed these social relations and then prioritize the rights of one party over the other party. And so debt contract became, immutable creditors' rights. Wars have been fought for centuries, basically around this whole question of creditor rights. So if you look at many of the wars in the Roman Empire, they were really one group attacking the other for being held by another kingdom and vassals for, for debts that they owed them in slaves, in metal, in produce, and in many ways these wars have been won, but overall, since the American Civil War, there has been the American state has had a way to basically impose mechanisms that anchors creditors' interest over. So it has become the norm that money, which is a debt creation, is that the creditors' rights are immutable. Now, again, not too long ago, as I said, this was not always the case. This is why we had usually some jubilee, some celebration once in a while in 100 years or 1,000 years, and there is a rebalancing of the creditor-debtor relationship for the purpose of the peace. But this has basically eventually with the rise of American power, especially post World War I and II, when the United States transformed itself from a big debtor to a major creditor, that the creditor power and creditor rights have now been fully entrenched. Now, so money creation has now increasingly become the power of the printing press of a few large countries. So and there are, as we see from the United States, the Federal Reserve is an association of private banks. So in contrast, so the money is printed and supplied to the rest of the world. That excess supply to the rest of the world is debt to the source of the source of the paper money, and this has then entrenched the debt system as the main driver of money creation, and this debt system is anchored in private financial institutions. And this is not a moot point, because in an earlier conference organized by Open Society, I think there was a whole discussion about, why is it that Africa has set preference for foreign exchange denominated debt? Why isn't its printing press being put to use for, for driving development and growth that does not require, for foreign exchange, for example? And this is because, it has now become to internalize the system. Also now requires a lot of the application of political power. And this is the relationship between power, politics, money, and debt eventually. So we have a system of a dollar-dominated credit system backed by, until now, by American political power. And that creditor system is largely a private system. And especially with the rise of the globalization of the processes in the 1970s, 80s, then political force channeled through institutions basically now force the opening of financial markets and the collapse of capital controls. Okay, I took this quote from Radhika Desai and Hudson, that have been looking at this creditocracy question, And I thought it was important to, it captures the point I was trying to make, which is that the key to understanding the world monetary system is based on national currencies of the dominant capitalist countries, is that they are primarily financial systems. They are private credit funds, the battering ram of their international projection as world money. International monetary systems have therefore been the financial systems of particular countries, governed by central banks that in most countries represent the interests of financial sector. They generate vastly more private credit than public money. The results have been international rentier elites and world creditocracies, first centered on sterling and then the dollar, and to a minor extent the euro in recent times. So their power extends through networks of institutions offering private credit to the world's households, the firms, governments, and dealing in financial assets, such as stocks, bonds, and other securities, and their derivatives, especially for real estate and natural resources. So the network is ultimately protected by international power of that state. And this is very important because this defines the relationship between Africa and the Bretton Woods institutions, the relationship between military presence and the credit system, and the increasing commodification of everything else that is social value, because it has to go into the credit, into a system that can be controlled by creditocracy. Now, this might seem like I am making a big fat thing out of it, but it's important because, as I said, we are, if we take a quick look at our debt profile, we are totally, very heavily, dependent on a few currencies that are printed by a few of the world's powers. So our accumulation distress basically has a long history. It is rooted in the dollar credit system that was already, dominant at period of colonialism, especially following World War I. So the system, we became dependent on the pound, and to a smaller extent, the French franc at that time. But eventually, the dollar became steamrolled through as the United States basically took over the global economy, and the dollar basically replaced. So if you look at the data on the dollar is now, finances well over 80% of global trade. And so, and therefore, it's not surprising that the African continent is also denominates everything in its trades. And we have failed to deal with this because we fail to recognize money as a social system, as a social institution, and define the role of money creating institutions and the public sector itself in money creation for social value. We have failed to unite politically. Therefore, as we will see towards the end, that whereas other regions are finding ways to override the dollar denomination, even our new institutions we are trying to create further entrenches itself in it. We fail to unite politically and become a big enough force. We fail to restructure our economies beyond the primary commodity dependence bequeathed upon us. We fail to sustain the fight against structural adjustment programs. That started briefly as the Lagos Plan of Action of Adedeji's and so on. They were steamrolled over, and structural adjustment came into town. And we have created a new elite that basically are self-serving, make wealth and power through actually pioneering and driving the dollar credit system in their appetite for things like Eurobonds. And I think we know enough about the rapid growth of the Eurobond market, on the African continent. So, okay, the idea was to take a quick look at our debt profile and see what it means in terms of our political relationships externally and the implication for our domestic political relationships. So as we can see, private debt has basically is the single largest component of our debt, and it's mainly Eurobond and some bank credits. And then we have the Paris Club. If you add the Paris Club and the bilateral, of course, they're bigger than private capital, but they all kind of Western banks and interests intertwined. China is becoming quite important. We all know that. And I think we will discuss very quickly about the role of China and the relationship between China, because its system of financing is similar to, but also in some ways differs from the dominant dollar systems of financing. And the World Bank, together with the IMF, are slowly becoming smaller and smaller players. So if we take a look at the timeline context, we can see private debt rising quite rapidly, and multilateral debt sort of stagnant, and bilateral debt collapse, declining faster than the rest, and China's debt increasing. But we need to keep our mind, our hands. So in terms of the overall composition, we do know that our appetite for external debt is far higher than our appetite, is marginally higher than our appetite for domestic debt. Although in more recent times, external debts, because of, until recently, the increasing difficulty of accessing external money has forced some countries to finance their deficits through domestic borrowing. But there's no domestic borrowing, not necessarily through the central bank that creates social money, but through private banks and so on. So our relationship is very much increasingly very tied up with the private market. The political economy of the private capital markets is a lot more tenuous, because it is very difficult to get a hold. They are protected by the initial credit protection laws that have been entrenched, and various and UK government, UK laws further entrenches that protection of creditors versus private fellows. They are hard to get a hold of as individual institutional political entities. And so for that reason, it's the relationship, unless we find a mechanism, their organizational representation and the mechanism by which they operate, specific elements of their operation, the role of credit rating agencies. There are specific institutions we can engage, and their organizational representation for private creditors. There are institutions we can engage, but increase they are hard to get hold of. And bilateral credit is, as we said, is declining. There are countries with voters who can provide an ethical pressure, as we saw with the Jubilee campaign and the HIPIC debt relief, because they are political entities. So the swing of the political mood by voters can make an impact. This is slightly different. With China, China has a different mechanism. We do not yet understand sufficiently how to find pressure points on China. But we know that when there are pressures, they do make some shifts in debt restructuring. Some of that restructuring actually do lead to debt reduction. But they are building new systems. They are less amenable to voter pressure, because it's not the democratic system. It's not the way that Western democracy, liberal democracies have been shaped. And therefore, the increasing rise of China, in the role of China in our political economy, has many positives, because it allows for diversification. It has negatives. It allows for us to see different ways in which financial relationships can be established. It has negatives, because there are problems of transparency and accountability, and it is inherent in the structure of politics of the Chinese. But nevertheless, there are Chinese research institutions and Chinese civil society organizations that are important potential partners for getting to the Chinese state. in seeing in creating reforms. Now, now I had made a point earlier that he who controls the print house controls the power of credit, and I made the true away point that the U.S. controls more than 80% of settlements, trade settlements around the world, 62% of central bank gold and foreign reserves, more than half of global debt is denominated in U.S. and so on. The interesting thing about the United States and the dollar denomination is that there are now analyses that show that the power of the U.S. dollar is declining, and that and it might ultimately really decline to one of these smaller, another currency of a bigger basket, and therefore there might be some room to address this. The franc zone on our continent is 12 countries, but it's over 180 million people that it touches, and the dominance of the French colonial relationship since 1864 is quite outstanding. That it's been possible for them to continue to dominate, making it almost impossible to think about money as a social institution in any of these francophone countries. But there are struggles going on, to losing the stranglehold of France and over the franc zone countries, and I think supporting those struggles is actually important for creating the conditions for a much better unification of economies. Even if it is the West African sub-region and the Central African sub-region for a start, and which then integrates into the Pan-African integration process. So the yuan continues to play is important, but it continues to play a small role in Africa's money and the basket of transactions. But the future monetary system is tilting towards Asia, and it is also tilting towards electronic money, and it will be a mistake to define the relationship with China simply through the extractive industry sector and our concerns about it. It's important to see how this political system is transforming, so that the monetary system, the global monetary system, transforming, so Africa doesn't come to it too late, as it often does. So the implications of this geo-credit economy for Africa's political economy. So as I said, the stranglehold of the dollar and the U.S. political power, it is still strong, but it's perhaps declining. The stranglehold and the rapid financialization that it is driving is creating serious social costs. And these costs translate into increasing poverty, declining public services, the privatization of services, increasing inequality, social inequalities in very fragile societies around the place. But it is declining. What can Africa take a second look at the role of its own central banks in money creation and local currency denominated debt to finance deficits as a source of growth? The future of the global economy, as I said, is going east, dominated by China and India, and it will be so probably for a while. There are a lot of innovations going on in those places, and it will be important to not just create our own institutions modeled on the institutions of the West, but also have a sense of how these institutions to the East are evolving. Our economic structure and negotiation strength remains weak. Without diversifying the economy, the ability to create money without runaway inflation is constrained. But how can economic transformation happen within the frame of a fiscal squeeze? Creating that balance is absolutely crucial to drive growth and transformation as a means of creating the collective political power for political bargaining. My final slide is to take a look at ongoing alternative financial systems being built. As I said, some analysts say the future of debt and money is multilateralism, as if, although there doesn't seem to be a lot of hope in this because of the way the United States have sought to dismantle multilateralism. But as the United States itself deals becomes a smaller and smaller player, the changing nature of the global economy is already essentially multilateral. It's just unbalanced multilateralism. And multi-currency, multi-currency world is becoming the norm, and that also includes the digital currencies. So some work has been done looking at how Russia, the EU, and China are building their alternative financial systems, as I've said. Many countries are also increasingly moving away from the dollar-denominated trading and financing relationships. So some kind of, people call it de-dollarization processes. And we are probably wise to take a look at these dynamics. The BRICS started something. Is very much modeled on China and Asia generally. They are trying to promote an alternative form of financing so that they are actually directly supporting the production of goods and services, including infrastructure, rather than just paper money. And the struggle is about how, how these emerging processes in Asia, including China's Belt and Road Initiative, that the engagement between African countries and these processes can push for some more equity. So South Africa doesn't become the only face of Africa, because these dynamics are sweeping across the place. And those are challenges for the African Union, but also for Pan-African societies. We are, of course, building our own monetary initiatives and institutions. We have working on an infrastructure bank. We have an investment bank. There's an ongoing process on central banks. Civil society hasn't really taken a careful look at how these institutions are modeled. How much are they modeled in line with the dominant dollar credit system, or how much space is there for these institutions to evolve differently? For civil society organizations, I think for our interest in political and economic engagement is that economic and political and social systems deliver equitable development and protect the environment. Within those lenses, I think our engagement challenges are much bigger than our engagement with our governments within the country. It's also understanding these systemic drivers of change. Okay, thank you very much. Sorry for going on for too long.
No, wonderful. Thank you very much, Charles, and indeed very insightful presentation here on the political economy dimensions of debt accumulation. And I think the one thing that struck me in your presentation, Charles, is your starting slide around the commoditification of money and how it has evolved from fulfilling its social purpose to it being a burden in the form of in favor of credit and that imbalance. And I think, listening to your presentation, but also having read through the paper that you presented during the OSF session late last year, I think one thing that is clear is that this complete or this continuous movement towards an imbalanced relationship between debtor, creditor, or the holders of money, should I say, in the context of this conversation, is pitting the continent in a very precarious situation, particularly when we look at how the current crisis, for example, is unfolding. If we were to just sort of hone in on the premise of how capitalism has transformed money, and look at how the countries like Zambia, for example, have struggled to negotiate with their creditors, or how our governments have struggled to put up a common position in some of the global initiatives, whether it's through the DSSI or the G20's common framework. And I'd like to explore, this premise that you've put on this evolution in the context of the current crisis, and if you could provide a little bit of an insight of how do we sort of address this aspect in the context of the current crisis.
Okay, so we are addressing the current debt distress within the context of having to develop, having to ensure that the economies are growing and transforming. And so it's the fundamentals remain the same, which is that we need to rescue the social purpose of money, and that has a number of dimensions. One, as I suggested in the presentation, was that we need to reopen the conversation about the role of central banks in money creation and deficit financing. Two, we need to understand that exchange happens sometimes of goods and services happen a lot outside of the exchange of paper money. So mutual labors, that communities provide to each other, mobilization, community mobilization for the supply of anything from planting trees to terracing things. Those mutualities were the foundations of money, because that's a social purpose. One set of actions of it's in exchange for another set of actions that create a stable, thriving, non-conflictual situation for societies. We have to take mutuality quite seriously. We have to take the efforts to create money from the bottom up quite seriously. The problem is that mobile money companies, which are also mostly external companies, foreign companies, dominate that market, and then aggregate these small savings into very large capital and turn themselves into financial institutions, and then basically create money and the profit that goes with it and funnel it out once more. So this inability to mobilize and create money that is internalized is very, very important. And mutual credit savings and loans organizations by women's organizations are not small things. The way we think about our pension schemes for those who still have a formal jobs, the way you create those pension schemes, the link between public insurance schemes and the public investment. But insurance is completely left also to the private system. So it takes a different way of thinking to create the building blocks to slightly withdraw from dollar credit and substitute that credit for domestic money in domestic currency denominations. So that's the one part. The second part is, of course, in our campaigns, that it does make sense to refer to the fact that this creditor-denominated power is only recent, and that in the past, wars have been fought successfully to overturn it, and wars have now been fought to entrench it. It's not a sustainable system because it then screws the whole world and the environment alongside it. This fundamental is hard to sell, but it's really the key debate. So for now, they should do a jubilee, wipe out the debts, not only of the poorest countries, but of developing countries. The idea was to use sufficient, SDRs issuance to enable governments to have the reserves to address some of the debt, to be able to borrow some more and restructure the debt and things like that. But as we can see, the size of the SDR issuance is pittance. My government is celebrating this $1 billion. But at the same time, they're just about to go and borrow $1.5 billion to help a struggling oil company to buy up a totally useless oil reserves from a Norwegian company. It's so we still have to maintain our campaign that it is ethically right and that it is right in the protection of humanity and the environment that these things be wiped out, and that they are not aberrations to say that money and has a social purpose than a private purpose, and we have to deal with it. So we have to be bolder in our campaigns messaging, actually.
Thanks. Yeah, that's a very good point. Actually, I was going to come to that, and I'm really glad you touched on the special drawing rights issue, because it is something that has been lauded across the world. Given the quantities, though, of course, yes, very, very important to put it in context of what it means for the continent and then countries more specifically. And I think that also then brings out again this political dimension of how the power relations, even within the current construct, continue to play out. There's a couple of questions that have come in the question box. One is from Malina, who's asking that what chance do you see SDRs in changing the system of international currency hierarchy, especially as all currencies in different degree profit from the seigniorage of the newly created money, in difference only of northern firms, banks, etc., profit from further injection of US dollar or euro. So, and then the second one is it's from an anonymous person, but they ask, with regard to the African continental free trade area, are we not going to see a rise in intra-Africa debt, strengthening of African currencies? So I don't know if you want to pick those two first, and then we'll come to Miriam after.
Okay, so the SDRs, as you can see, the allocation of the SDRs are still very heavily towards countries that have the capability to turn their printing presses on. So it won't change the relative balance in any form. It does have some liquidity relief for developing countries. That liquidity relief can disappear very quickly with the commodity prices, if the commodity prices decline. That reserve cushion will go when commodity prices decline for one reason or the other. So if we were to make SDRs an instrument for a potential rebalancing of the system, then it has to be substantial, and it has to be, the allocation formula has to change fundamentally, that the weighting has to be for developing and middle income countries. And that provides sufficient relief to anchor local currencies, to give them the room to migrate more and more towards raising local money going forward, but not now, not this. So we really have to be a lot more ambitious. It's a welcome liquidity relief, but it's just what it is for a short while. But we must also start looking at the way that these alternative monetary systems are being built. I mean, the Chinese and the Russians and the Indians are very aware of SDRs, but they know that it's also founded. This is an IMF instrument. It's founded on that whole dollar credit hegemony of the United States of America, and there's a limit to which you can rely on it going forward. As you can see, it's very difficult to rely on the United States for a very long time for anything. So they are aware of this. So we may also have to take a careful look at the benefit we push for more SDRs allocation, but it won't change the nature of the monetary system. On the African continental free trade area, whether or not it will help us to actually encourage domestic local currencies and do payment settlements by local currencies, it has a potential. And so this is one of the reasons why the African Monetary Fund is being envisaged, so that there is a way in which, you know, we can provide payment settlements. You know, but trade, as the Europeans have taught us, trade integration doesn't work that well without political integration. Every small country has its own geopolitical interests, and they will, you know, like it's happening. I sit in the West African space, so I see what is happening. The Nigerians and the Ghanaians are having spats all the time. Nigerians will close their borders. The Ghanaians will try to kick out Nigerian traders, although we are supposed to be ECOWAS, right? So each of these small geopolitical interests with our political, you know, political union, there's a limit to what you can actually achieve.
Thanks, Charles. I'm just going to pick up one question that has come from Miriam, and so she's asking, how have African governments been convinced that external US dollar debt is the solution to fiscal deficits, and that access to private financial markets has priority over asking debt relief for servicing their people? She says you explained it partially, but what are the mechanisms? For example, investment banks, rich countries not forcing their private creditors to provide debt relief, etc.
I think she nailed the nail on the head. So I take my own little country. So my finance minister runs a private investment entity, data bank, right? It is very much, data bank acts as a transaction advisor to virtually most of the, you know, market transactions that are being done. So every time you raise some private money, there is some commissioning and some commission and some share to data bank. Many of these political leaders are entangled in this way. So raising debt is actually a mechanism for transferring public money to private hands through institutions that they have set up. I don't know that every country is like my country, but definitely the direct relationship with investment bankers, you know, just makes raising private foreign exchange denominated debt a big incentive to do so. And then they will wrap that up in with a political flag, which says that, see, our country has managed to raise this much money from Eurobond. This is a mark of big progress. And then we have had a marginal reduction in yield. This shows that our macro economy is doing well. So it's in a way, it's sold as a political gain, something positive. And going for debt relief, which makes more sense. And they will quietly want some debt relief, but they won't announce it. They won't align publicly with civil society to say, damn, these private creditors, they have had enough. They should also take a haircut. They won't do it because they fear that credit rating agencies will rate them down. And then, you know, when they are going back there, it's too expensive. So these are some of the dynamics I observed, Miriam. A self-interest. There is a warped perception of good progress by going for private credit rather than asking for debt relief. There are domestic political economy factors. You know, you've told your opposition, your opponents when they were in government, that they weren't asking for debt relief. That shows that they have failed the country. Now it's very difficult to go out there and say debt relief. My president has a policy about Ghana beyond aid. We don't want aid. But debt relief is aid in many respects. Now, that's really, some people have to write it off, you know, from their books. So those are the domestic political economy things. And civil society has to keep calling them out. In the end, it will help them. I recall the HIPIC debt relief in the Jubilee campaign. My former finance minister, Kwesi Bochwe, at one panel, I think it was in Brussels, basically was invited by civil society to as a potential partner in the fight for debt relief. And he said that this debt relief thing, we will screw up the international credit system by doing this. But when it became obvious that the civil society were becoming quite successful with, European government for debt relief and the World Bank, he became a champion for debt relief. So we have to keep pushing until the political messaging change internally.
Thanks, Charles. I want to just pick up a couple of things actually that came up in the opening session this morning, and also in the first technical session that followed. And it's really linked to the monitoring of what is driving some of the continental initiatives, and are we paying enough attention to see if they are genuinely an alternative or just a reamalgamation of what is the current system, but with a continental face, if you like. And one of the things that a lot of people have been speaking about quite loudly is the liquidity and sustainability stability fund that's being proposed by the ECA. And furthermore, also, proposals, for example, that came out from the African Development Bank on buying back a buyback procedure on some of the bonds, and how the special drawing rights might be used in this way. But I just wanted to see and get your perspective, particularly on this alternative, but also monitoring what initiatives are being put forward by the continental IFIs, the extent to which they either mirror the status quo or are genuinely trying to, for example, make credit more accessible in terms of maybe making it less risky or less expensive to borrow on the continent, or is it just a continuation of the same thing? And that's sort of related to a question that has been asked by Malina as well. Thanks.
Okay. For the LSF, the Liquidity Sustainability Fund, fortunately, there are a few pieces of independent analysis of the proposal. So we could always share and read those analyses. One does not want to impugn negative motives. The UNECA executive secretary, having been in the trenches with the IFC, understands how the private market for credit functions. Now, she wants to she believes in the market mechanism as a way of addressing the credit needs. She actually says that the access to the Eurobond market is very good for Africa and the African countries that have it, because it has helped them to diversify and to manage, their portfolio, of credit resources. And there's some truth in that. So she wants to play within the market. But what I understand by that particular, initiative is that it still requires some donors to put some money on the table, together with some of the allocation of the SDRs, to be used to de-risk overnight credit. Put this way, rather than put the aid into roads and things like that, or SDRs into, reserves, but draw down the reserves to import equipment for dams, put that money in a fund that will make it less risky for bond traders to sell bonds to Africa. So, but how long? So if you look at the people's analysis, well, yeah, but for a short time, there are many things that affect Africa's credit rating. You just need a couple of terrorist attacks and the image of the continent goes down. You need a drought in 2 or 3 major countries, and all of that goes tumbling down. You need a 1 or 2 military coups. You need a major fall in commodity markets. So in a way, it can work for a short time, but not necessarily for a long time. Now, having decided that you would only play within the market mechanism, it is difficult for her to be the champion of debt relief, the participation of the private credit market in writing off debt. So that's a conversation that has to be had with ECA without impugning anything of wrong motives. But we each can have our own analysis of whether it is better use of money to use our SGRs and our debt to anchor stability in our currency so that our central banks can print some money, or we should anchor it and reduce the risks so that we can borrow at a marginal reduction in yields from Eurobond market. Those are policy things. As for debt buybacks, they are not new. They are already doing them. Countries are already doing them. They borrow money to buy back existing debt, whose terms are harsher. So you basically postpone borrowing. Again, my government has been celebrating zero coupon bond. That simply means that right now, instead of agreeing that my interest rates, so my coupon yield will be 7% for the next 3 or 4 years and so on and so forth, we pay nothing for the 3 or 4 years. But at the end of the 4th year, all of that accumulated nominally agreed interest will be paid off at once. Now, the political trickery in this is that if you are not coming back to power in 4 years' time, that is somebody else's headache.
Yeah, I think that's also linked to actually one of the final questions that came through about the moral hazard that comes with that sort of approach, isn't it? Is that you sort of leave it with somebody else, for somebody else to deal with. There's a couple of more comments, and I do realize we're coming very close to the 1 hour mark for which we had slotted this session for. One is from Kwesi, and what he says is, given that the main driver of commodification and privatization of debt today is the US, and is also about almost about the most indebted country on earth, it is obvious the debt distress of African countries yet again is cyclical. Thinking of innovation, isn't it possible for Africa, for example, to commodify the 24/7, 365 days sunlight as we look towards energy transition, for example, to mitigate the appetite for traditional debt, finance sustainable development on the continent? He says, I'm thinking about how do we innovate away from dominant norm and set new norms that better empower Africa out of the debt trap. So that's Kwesi's comments stroke question. And then lastly, one on back on the CFTA as well, asking a lot of the reason for debt and SDR has been to meet the current balance deficit on foreign reserves. Do we think the continental free trade area will likely reduce this? So I think maybe those two, and then some sort of closing reflections as we come to the hour mark, Charles.
Okay, so the question, we have an abundant resource, but we don't have the abundant control of the technology to convert the resource. And that's where our problem has always been. So because we are very dependent on the technology is still advancing. It still comes back to, in the end, the investment today and the returns in the long run compared to an alternative investment. But certainly, renewable energy, to the extent that There are binding agreements that also bind our countries. There are costs we have to incur anyway. Therefore, we have to try to resolve the technology question for harnessing power and turning it into energy and green energy going forward. It's the same thing with different sorts of views and ideas about green energy and how to harness them. Because our continent for a very long time, I think things are improving. Really haven't been investing in technology that much, engineering and things like this. We still are quite far behind. But that doesn't mean that, so that actually then starts Kosi by saying we have to start prioritizing technology that allows us to make some shifts going forward. But in regards to the African free trade area question, yeah, I think a similar question was asked earlier. Yes, it can help, but first we really have to take it seriously. So we have to stop harassing each other across the borders. We have to stop harassing small traders. So those who come by trucks across the borders are really badly harassed, at least in the part of the Africa that I sit in. There's a lot of corruption in it that raises the cost of doing business, and therefore just encourages and incentivizes this trading relationship that is to the west and to the east. So you still have to deal with these political dimensions of the free trade area. Otherwise, it doesn't quite work.
And just one last thought that's come from Stevenson. He's asking about how do we increase capital production in Africa? And I remember actually, sorry, Stevenson, I should have brought this up. This was also a feature of the session you talked about in November last year during the OSF session, you and David D and Sialandongo about capital production and capital accumulation. I think it would be great to also see how that dynamic plays out in terms of debt accumulation, because it dovetails exactly what you've said right now in response to Kwesi, right, about the technology and exploiting then the abundant resource.
And if I link that to, if I recall, Ndongo dealt with it much better than I did, and his main point is that we have to understand that the way in which domestic firms accumulate capital is that put another way, the way in which a government can best help domestic firms to accumulate capital is financing the fiscal deficit. And he made the point that fiscal deficit is not always a bad thing, because that excess spending by government is what pumps capital into enterprise. But that spending cannot be external. If you are spending it servicing debt and spending it importing all sorts of useless things that can be domestically produced, then that money is not true to domestic firms necessarily. But so the procurement system, the public procurement system, when it works in an unbiased and competitive way, but also targeting particular forms of capital accumulation and technology, can best be financed through fiscal deficits. So that was his point, to try to rescue fiscal deficit from this negative perception and link it to the way in which capital can be passed on to companies who then transform that capital into goods and services and into industrial and productive capital. So,
yeah. Sorry, please carry on, Charles. Yeah.
Oh no, I think that works for now.
Okay, great. Charles, thank you very much. We've just come to slightly over the hour, but it's really been an enthralling conversation that really puts into perspective the different dynamics political dynamics at play here, and when one looks at it also beyond just finance, I think towards the end here we've talked about issues of capital and technology. It does really put into perspective the amount of work that is needed by civil society organizations to continue to push this alternative agenda. And I really do like the points you made towards the end of your presentation, Charles, where we need to not just open arms welcome the initiatives also that are being pursued by the continental institutions. We need to really interrogate that they are not just a recycling of global norms or global practices, but instead they are genuinely thought through as alternatives and to what is currently dominating the agenda. So I would like us to end on that note, as an action point and as a takeaway for us as civil society, as advocates, researchers as well, and academia, is that, really to start thinking through how we can interrogate those things further. Because one of the things I noted previously is a lot of the policymakers who are trained as well, many of them are trained within the construct of the dominant theory or the dominant political philosophies and ideologies. So there's very little wiggle room in their minds, or that creativity or innovation in their minds when it comes to policy making as well. And I think we have a role as civil society, as academics and researchers to try and interrogate that. So Charles, thank you very much for this. There is a huge demand for your presentation. With your consent, I may share it if that is okay with you, and we'll put it on the conference website.
To read and sign the Harare Declaration, go to www.afrodat.org/initiatives. Click on Afrodat Conference on Data and Development, and then read more. And finally, the outcome statement.